finally, on the year-over-year core, it's 3.2%. 1/10 lighter than the rearview mirror, 1/10 lighter than expectations. But, 3.2 is a little bit of progress. It equals where we were in August. Now, that equals August. To find a lower number, you're really going in the Wayback Machine. You have to find a 3% number, and that's all the way back in April of 21. Now, many don't look at the indices. I look at the indices. This really says it all, okay? If you look at the CPI index, started in 1913, it now is 315.605. 315.605. That's the second highest number ever. The highest, the record, was October of 24. If you look at this, pretty much every month we make new all-time highs. So it's nice that we pulled back just a smidge. And if we look at the year-over-year, core, going all the way back to 1957, 323.38, that is a new all-time high. What does that tell me? We could look at these numbers based on expectations like we do, but the reality is, even yesterday, if you looked at some of these smaller month-over-month numbers, it just means that the inflation rate is growing more slowly. It isn't going in reverse, and that's what these indices tell us, that virtually anybody out there watching that isn't an economist, they feel the pressure of rising prices, and it's a pressure that very much never seems to ease off. We don't normally see a lot of negative numbers. And speaking of negative numbers, there's one I haven't pointed out yet. Empire was also out. January number, kind of real time, minus 12.6. Minus 12.6 would be the weakest, going back to minus 15 and change in May of last year. So we still see that manufacturing is a bit curtailed. Interest rates moving significantly lower here, significantly lower. Maybe it was the month-over-month core. Maybe it's the fact that we came in as or a little light on expectations, what the market prepared for. But like yesterday, we want to watch the secondary and tertiary response as we get closer to the opening of equities, because it may be a very short-lived rally pushing yields down. And I do want to point out that we have traded slightly on an intraday basis above 480 in a 10. We touched 5% yesterday briefly in a 30, and the dollar index, well, even though it isn't monetized now on Monday, it was at a 26-month high close. Becky, back to you.
Okay, Rick, stay right there. A lot of analysis. We need more from you, but we also want to bring in the rest of our panel. Priya Misra, who is fixed income portfolio manager at JP Morgan Asset Management. Our very own senior economics reporter, Steve Leisman, and Peter Bookvar, who is chief investment officer at Bleakley Advisory Group, also a CNBC contributor. Steve, why don't you walk us through what you are seeing as you dig down into these numbers?
Well, it's a good number. I think it's important. Actually, Rick was using a different consensus, 0.4. We had 0.3 from the Dow Jones consensus. I'm not sure which one Rick is using.
On the headline, month over month.
On the headline, but the important thing is we both agree the core was lower than expected at 0.2, and it looks okay. It doesn't look, like I said earlier in the last hour, the PPI downside surprise took some of the edge off an upside surprise today, and I think that came to pass. The big number, the number that both of our guests asked before right away, was the owner's equivalent rent number. That was up 0.3. We were doing 0.5, 0.6s, big numbers there. Now it's more contained, a 0.3 after a 0.2. You did have apparel was well contained. New vehicles up 0.5, used cars up 1.5%. That helped it. But take a look at commodities. Let's do services less energy. That was up 0.3%. So not terrific. You need to do 0.2s to get to 2%. But Becky, we'll take it. It's a good number. You can see how concerned the market has been with this possibility that inflation was going to get out of control. So this now sort of says, all right, the Fed can be on hold, but we don't have to talk about this thing that Joe likes to talk about, which is what, the idea of hiking rates.
We're now looking at the 10-year falling below 4.7%, 4.69.
And while you talk to the other guests, I'll update the probabilities on what the outlook is for the Fed and how that's changed. I got to do the math.
Priya, I would say that, look, the Dow's now indicated to open up 600 points, but that's going tick by tick with the Treasuries. You focus on the Treasuries market, on the fixed income. what do you think of what we just heard? Is this the right reaction based on these numbers?
Absolutely. I think we were in the danger zone. As the 10-year got closer to 4.75, 5%, I think it's a danger zone for the economy because there are interest-sensitive sectors. Look at the mortgage market or the housing market. Look at other interest-sensitive sectors. We're also in the danger zone for risk assets because, cost of capital that high, you're going to get more dispersion, you're going to have impact on multiples. I think this is a good number. It's a sigh of relief for the bond market as well as the equity market, risk assets in general, because it takes that Fed hike. I think, we priced out a lot of the Fed cuts in the last few months. And now there was talk, well, if inflation's moving up and the big question still remains, what are we going to get from the administration? I would argue there's a market constraint, there's a political constraint. I don't think you're going to get that much, but I also think that that's behind in the market's mind. Are we going to get significant fiscal easing, which is why the long end of the Treasury market has been selling off? I think that's still an open question. We'll get this big, beautiful bill with significant deficit finance tax cuts. I don't think that's happening. That's still going to be in the market's mind. But I think the reaction where, okay, inflation is slowly but surely getting close to that 2%. It's just taking longer. I looked at shelter because shelter is a high component of CPI. It's been frustrating in terms of how quickly it's coming down. But it is slowly heading lower as primary rents are heading lower. So I think good reaction, but we still have lots of questions around what are we going to get from the policy front.
Yeah, and Peter, I'd ask you, how much confidence do you have that this number is indicative of a trend of lower inflation? Can you bet on it?
So on the good side, we've already seen all the disinflation that we wanted to see. In fact, around zero year over year was really the pre-COVID trend on the good side. The services side was really what was keeping overall inflation elevated, and I do expect that to further decelerate as lower rents work its way through the number. I think the key question, though, is there's one thing to have a spike in inflation, the deceleration. There's another thing to keep inflation down. It's the sustainability of keeping inflation lower that still remains to be seen because we've got a good inflation number. It's still kind of sideways around this 3-ish level, which is still quite different from the 1 to 2% trend that we saw pre-COVID. And then that flows through having interest rates higher for longer. And the interest rate move is not just a U.S. thing. It is a global thing. And one of the good setups into the U.S. CPI number was a less than expected UK CPI number that took some of the heat off the gilt market, which was a good setup for a rally in treasuries today.
You both asked Steve about the owner's equivalent rent number. What's the second number that you look to after housing costs?
I would say service and supercore or ex housing service inflation. Because exactly to your point, that's been high. But I will highlight inflation is notoriously difficult to forecast. There's often one component or a couple of components that could be high. It's a noisy, bumpy series. And so we should not react to necessarily just one number. I think it's good news, but we do want to see that it's heading lower. So I'm also looking at wages. Are wages starting to
Well, they came down if you did the real earnings. They were obviously because the 0.4
Right.
comes off the top of the game. Just very quickly, Becky, I want to just tell you that the June probability, we're going to probably show a chart that shows it at 66%. It's moving, or 65%. It's 68% now. They updated it. So what does it say now? 65. It's 68 right now. So that's up 10 points, the possibility of a June cut. But look, the market still can't get its arms or its brain around the idea of a second cut. Right? That's where the market's been. And I don't think there's any reason to actually change that because of what Priya was talking about the fiscal policy uncertainty, and then also what Peter was saying, which is, I'm going to take what Peter said in normal English and put it into monetary policy speak, which is that they need to have the confidence that inflation is headed back to the target. And this is like a wrestling match where it's like 1, 2, and then the guy got up again. So we got to start counting again to have that confidence inflation's coming.
Can we really get to 2?
We need to do 0.2s. Oh, and that reminds me of one other thing, which all this matters for, you guys can't do this on the fly, can you? Calculate what this means for the PCE? Because later today, in about an hour or so, I'll start to get the guys who will plug in their numbers into their PCE model. And one of the things that happens there, Becky, is that housing is not as big a part of it. There are some other components that are bigger parts or smaller parts.
PCE may read hotter, even though we're getting weaker.
No, it should read a little lower. I think. I'm not sure honestly, because airline fares may go through, medical is higher, and housing is less. It's a funky thing that I just can't.
Will they move the goalpost to 2.5 if we don't get below 2.5?
I don't think they'll move the goalpost to 2.5. What they might do is, in the process of their review of their longer-term strategy, they might eventually go for a range, but I don't think that range would be higher than 2.5.
Well,
Do you think they put 2.5 into the range? Like they'd actually talk about it as a range?
1.5 to 2.5.
Well, that's two.
I think that's the way they want to talk about it. I think that's the way that if they had,
Remember how Larian said it
if
had
they had a
something
chance to redo it.
said it had something to do with New Zealand. What did he say? New Zealand? He said 2 was totally arbitrary, but it's more based on what is it, Bookvar? Is it based on gold's stock to flow, or where do you get 2?
So 2, he mentioned New Zealand because they were the first ones to officially
Say
anoint
2.
2%.
Okay.
But it's actually to the benefit of a central bank, because they say if inflation is at 2, we can have the Fed funds rate at 1 to 200 basis points above that, call it 3 to 4. Therefore, in a recession, we have rates to cut.
Right.
So the 2% is not what is modeled to be good for the economy. It's modeled to be good for what a central bank wants it to be
But
relative
it's
to where the Fed
important what
funds
we
is.
do too, isn't it? 3's bad.
Three is
bad.
really bad. The reason it's 2, Joe, is because 0 is a problem and 1 is too close to 0. It's that simple. There is a little bit of science behind it, but that's really the reason they don't want to be in deflation, and they're too worried or nervous being at 1 because it's too close to 0.
You don't want to be too high, or you're setting off.
I don't think 3 is going to be part of the discussion the Fed is going to have.
You think 2.5's okay?
I think that when you're trying to steer an oil tanker, you can't get it through a very tiny gap.
Like the Suez Canal.
Like this, well, exactly. I think what you need is to say, we were aiming for a 1.5 to 2.5% range.
Rick, what were you saying? You don't agree with moving the goalposts?
No, I think Mohammed and I are very good friends. I think his interpretation that, moving the goalposts isn't a horrible thing. You can move it to 2.5. It's all arbitrary. You know what? Many people ask me constantly, what would be the trigger, the catalyst to set this tinderbox of debt on fire? That would be it, in my opinion. I think the market.
Sorry, we're dealing with a lot of spam. We are dealing with a lot of spam calls. Please send an email. Please send an email. We are dealing with a lot of spam calls. Please send an email. Please send an email. Please send an email. We are dealing with a lot of spam calls. Please send an email. So basically the way that it works is you buy the subscription and then you tell us which shop you pay for one cupcake every day. We have an option where you can get all of the cupcakes up front. And we'll go right. That is essentially how the whole thing works. So how much is it? It's $360 for a year, and then it is basically a $100 for a month. $50 each month.
closing order filled.